They've been worse than expected, and they're all flashing recession as the Fed is hiking rates and as inflation continues to get worse.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
One of the assumptions, of course, in the 10-year budget is that we make it through 10 years without a recession, even though we're pretty much in a recession right now. And that recession is going to get a lot worse. And in fact, most of the next 10 years probably will be spent in recession. Whether or not the government wants to acknowledge it officially, we're going to be living through it. But I want to even talk about some of this economic data that has come out, starting with some data that we got last week that I haven't had a chance to speak about. And of course, nobody else talks about it because it has to do with the trade deficit. We got the merchandise trade deficit for the month of April. And the expectation was for an $85.6 billion deficit, which is a big deficit, right? They were expecting a horrible trade deficit. Of course, nobody cares because they've been horrible for so long. We've just gotten used to it, right? So no one really gives a damn about how bad these trade deficits are. Well, the trade deficit that came out on last week, I forget the date, but that trade deficit was so much worse than expected. It was $96.8 billion. The high end of the range of expectations was $88 billion. So that is an enormous jump, almost $100 billion in 1 month in merchandise trade. And if you look at how we got there, there was a 1.8% increase in imports and a 5.5% decline in exports. Now, the exports are measuring the health of the domestic economy. Now, I know a lot of these economists want to claim, no, the exports are bad because the foreign economies are weak and they can't afford to buy our stuff. That is BS. The reality is it's our economy that's too weak to produce the stuff. And of course, we're having to import a lot of products. If we had a strong economy, we could produce the stuff that we consume and we would have a trade deficit. Again, these economists like to say the increase in our imports shows how strong our economy is. No, it shows how weak our economy is, because if we had a strong economy, we wouldn't have to import this stuff. We could produce it ourselves. We're not producing it ourselves because we have an economy that's too weak to generate this production. But so not only do we have these surging budget deficits, but we have these surging trade deficits. And the message that we have sent to the world today, and that we will send, as Biden ultimately signs this, is that America is never going to get its fiscal house in order, that the deficits are going to rise forever, that even all of this bravado, this big, we need cuts, we'll default if we don't get cuts. We got nothing. So this is a shining example of why it's never going to get any better. And the only ceiling that's going to matter is the lending ceiling. When lenders say, no mas, I'm not buying any more U.S. government debt. See, right now we're talking about our own imposed limit on how much debt we're willing to take on. Well, sure, we'll take on as much debt as our creditors are dumb enough to lend us. What's more important is when those dumb creditors decide they don't want to throw their good money after bad and they cut us off. And they should cut us off when they realize that we're never going to stop. The deficits will continue, the spending will continue, and so ultimately the dollar has to collapse because inflation has to run out of control, and none of these bonds are going to be worth anything. It doesn't matter if we don't default. We're going to repay our debts with money that doesn't have much value or maybe no value. And so I think this is very bearish for the dollar, even though the dollar's been rallying and it rallied again today. And part of the rally was due to some better than expected inflation numbers that came out of the Eurozone. Although last week we got worse than expected inflation numbers out of the UK. I mean, they're still printing over 10%, I think, year over year. But the numbers in Eurozone were a little bit lower than expected. And ironically, again, that sent the euro down, although it recovered a good chunk of those losses by the close. But I think this is bearish for the dollar. Right? People maybe thought that, it would be bad if they didn't raise the debt ceiling. No, it's bad if they do. And again, this should be good for gold. Raising the debt ceiling means more debt, more inflation. That is positive for gold. Gold has had a pullback recently. I'll get to that a little bit later in the podcast. But all of this should be bullish for gold and bearish for the dollar. Another piece of economic news that we got last week, again, real bad. I mean, almost all the news was worse than expected. I'm just focusing on a couple of ones that were particularly problematic late last week. The Chicago PMI, right? That was supposed to be 47. It came out at 40.4. Actually, no, that is today's data. That number came out today. I jumped ahead of myself. Hold on, I got my slides mixed up here. The Richmond Fed manufacturing. Let me talk about that one first because that was last week. That was supposed to improve from minus 10 in April to minus 8 in May. And instead of improving, it got worse. It went to minus 15. So it was already bad at minus 10. And then it came out to minus 15. Now we know we're not manufacturing because that's one of the reasons that our trade deficit went up. That's one of the reasons our exports went down because we can't export stuff that we don't make. And if we're not making stuff, well, that's going to be reflected in these weak manufacturing numbers. And that is exactly what's happening. The other data point I wanted to talk about from last week that came out on Friday, which was one that the markets did pay attention to, unlike the trade deficit, which, they completely ignored. And that's the personal income and spending numbers. And the income number was pretty much in line. It was up 0.4. But the spending was up double estimates. They were looking for up 0.4, and we got up 0.8. Now, why are Americans spending so much more money? Well, obviously, it's because stuff costs more money. That's the real reason that spending is going up, because prices are going up because of inflation. And in fact, even in the data, the PCE, and apparently, this is the Fed's favorite way to measure inflation. And that's because it's the least accurate, right? It's the lowest number because it has the most substitution and hedonics and, sleight of hand. That's why the Fed likes it, because it puts the best possible spin on inflation. But even those numbers, they were looking for the month over month PCE to go up by 0.3. It went up by 0.4. But more important, the prior month in March, it was only up by 0.1. So we went from 0.1 in March to 0.4 in April. Despite the rate hikes, these numbers are going in the wrong direction. The same thing for the core. The core PCE was supposed to go up 0.3. It went up 0.4 versus 0.3 in the prior month. And look at the year-over-year numbers. Last month, the year-over-year increase in the PCE was 4.2. Now it's 4.4, higher than the 4.3 expected, but more important, above the 4.2, going in the wrong direction. And if you take the core year over year, stripping out food and energy, again, 4.7 for April. It was 4.6 in March, going in the wrong direction. Inflation numbers are getting higher, not lower. So how has the Fed made progress? How are we moving inflation towards 2%? When it's moving in the opposite direction right now, and rates are already at 5.25%, and we're potentially going to get another rate hike in a couple of weeks during the June meeting, when rates are going to be 5.5%, 5.75%, right? Adding to the inflationary pressures that are already in the economy because we are increasing the interest expense that everybody has to pay on the enormity of debt that already exists. Now, I want to get to the data from this week. I just started with the Chicago PMI. I already kind of, let the cat out of the bag on that one because I read it off. But again, I'll say it again. That came out earlier today, and it was a horrific number. This is like the worst Chicago PMI, since the financial crisis. It was supposed to be 47. a little bit down from the 48.6 in April. And it plunged to 40.4. I mean, the low end of the range was 44.5, and we're a full 10% below that number. This is a horrific number for the Chicago PMI. And of course, we've been down, I forget, something like 13 or so months in a row. So we've been in recession for a long time, according to this number, and it's actually getting worse. Now, when this number came out initially, there was a sharp rise in the price of gold, about $10, $12 immediately. Gold spiked when this number came out because this is bad news on the economy. But then about 15 minutes later, we got the JOLTS report, and then gold lost almost the entire rally. Didn't quite go negative. It went, from up like $10, $12 to up maybe $2 or $3. As soon as this JOLTS number came out, which kind of boggles the mind because the JOLTS number showed a huge increase in the number of jobs, openings, over 10 million. It was 9.59 million in March. And that was revised up to 9.745 million. And the consensus for April was for a drop to 9.35. I mean, why do people think this? Well, people are losing their jobs. All these layoffs are being announced. People are, losing their jobs. And now you have all, people implementing or starting to implement AI, and you're getting some job losses there, but you have job losses in the banks and the financials, and a lot of these companies, money-losing companies, are having to cut their burn because they don't have access to capital. So people expected the number to come down. Instead, it went way up, which makes no sense. I don't even believe these numbers. One thing in this is they give you the so-called quits rate, which lets you know how many people are quitting their jobs, and that went way down. And so that doesn't show a strong economy because normally, you don't quit your job unless you think it's easy to get a better job. So in a strong job market, people are likely to quit, right? But if the job market is weak, you're kind of going to stay put. You don't want to take your chances in the labor market because you may not get something as good as the job you have. And so the fact that the quits rates are going down would suggest that the labor market is not really as robust as this JOLTS report would suggest. So, but this is the only really strong number that we've had in the last week and a half. I mean, we've had a couple of numbers that might have been slightly in line or a little bit better, but not like that. But most of the numbers have been like the Chicago PMI, maybe not quite as bad as this one, but they've been worse than expected, and they're all flashing recession as the Fed is hiking rates and as inflation continues to get worse.